throughout the region. Rick, I want to throw out a big congratulations to you, and we look forward to working with you and leading the team going forward. So good job, Rick. Keep up the good work. So now back to the forum. As I mentioned every week during these sessions, our mission every day is creating amazing value with our clients, colleagues, and communities. And this forum is just one example of implementing our mission. We'd like to welcome you and everyone on this call to our 11th annual Commercial Real Estate Forum. This is a virtual series, and this year's theme is Shifting Gears. Our normal venue for this forum is held at Salisbury University every spring. However, due to the current environment, we're shifting gears and have created several virtual commercial real estate forums that have been held over the past few weeks, and we still have some coming up in the coming weeks. This will help us and help you get through this recovery and get back to business. If you missed any of the past series, you're welcome to view them on our SVN YouTube channel at your leisure. So we've invited several local, regional, and national dynamic speakers that will enlighten you on the economic forecasts, best practices, trends, and opportunities on shifting gears in this changing real estate market. In order to make this forum more interactive with everyone on the call, we welcome and encourage your questions. Please feel free to type your questions in the Q&A box listed below. Now I'd like to introduce you to your co-host, Wesley Cox. Wes is a CCIM and a key member of the HANA team here at SVN. Now I'll turn it over to Wes to welcome one of our sponsors. Wes?
Thanks, Greg. Good morning, everyone. This morning, I have the pleasure of introducing one of our valued sponsors and community partners this morning with Merrill Lynch. Mike Truitt is the office manager for Merrill Lynch. Mike's been in the industry for as long as I can ever remember. Talking about coming full circle, Mike hired me. He probably doesn't remember this, but I do, because it was important to me and an important event in my life. Mike hired me 20 years ago, almost 21 years ago, as an intern at that time, Morgan Stanley. I didn't, of course, interact with Mike a lot. He was the office manager there as well, but it provided me a great amount of exposure into the business world and a little bit what they do every day. So here we are, 21 years later, approximately, virtually sitting in the same room. And now I get the opportunity to introduce Mike as one of our sponsors and partners of our virtual series. So Mike, I'm going to go ahead and turn it over to you, my man.
Fantastic. Can you hear me?
We can. Thank you.
All right, super. Well, Wes, of course I remember that. That was 20 some years ago, but it seems like yesterday. But let me start out by saying thank you to Sperry Van Ness and Miller Commercial Real Estate, and especially Amber and Wes and Brent and Amy for setting all of this up. You must have had a crystal ball this time last year when you chose the theme Shifting Gears, because I don't know of any time in any of our lives where we've had to shift gears more than the last 90 days. So that was a fortuitous theme that you picked, and I think it's great. So as Wes said, I'm the resident director of the Salisbury office of Merrill Lynch. I've been an advisor since 1983, and I have two team members, Patrick Sears, who's joining us virtually, and Sharon Perdue. So before I turn it over to our speaker, Nick Giorgi, who's joining us from New York, I just want to, we toss around a lot of terms, and a lot of folks are dialed in from different industries. So I just want to make sure they understand the role that Merrill Lynch and Bank of America play. So we practice a service called wealth management, and that's a term you hear quite a bit of, but sort of the elevator pitch on that would be, we help folks identify their goals, then prioritize those goals, and then help you match your goals with your resources. So, everybody talks about college and retirement, but there's other goals such as elder care, or maybe you have a special needs family member, philanthropy, wealth transfer, encore career, whatever it is. We help you prioritize those and put them on paper, and then, fund those goals through your resources. So the way we get there is one of our best resources at Merrill Lynch is our Chief Investment Office. And so the Chief Investment Office is our strategist. These are the folks that sit there. These are economists and market strategists, folks with PhDs and master's degrees who look at the world and take a very high altitude macro view of the world. And they look at the world through the lens of economics, but also social, political trends. We look at innovation and disruptors. We look at things like the climate and demographics, and all of that sort of goes into our, our macro themes. And then our chief investment office, once they've observed the world and tried to sort of make sense of it all, come up with actionable ideas. And that's what our chief investment office does. And so within that CIO, as we call it, we have folks like Nick, who are wonderful communicators. And they come out and they say, hey, here's what's going on in the world. And here are some wonderful ways to play it, or here's some ways to invest. And those ideas can be handled two ways. Number one, do it yourself. So if you're a client of Merrill Lynch and you like to sort of read through the research with your advisor and pick out ideas and take action on your own, great. Or the second way is using models where you say, here, Merrill, this is my risk tolerance. This is my time horizon. You do it for me. So Nick is one of the folks that puts all those ideas together. And I would just, before I turn it over to Nick, would just point out that Merrill Lynch is owned by Bank of America, which is the second largest bank in the United States behind JP Morgan. But Bank of America has a unique window, a front row seat, if you will, into the economy, because we see the activity in folks' banking accounts, checking accounts, credit card activity, loans. And so, we have a unique perspective that our economists and strategists, have access to. So it's really cool. And we think our ideas are really good. And so what Nick's going to talk about is basically life after COVID and all the changes that are taking place in the world today and how you and your family members can benefit from those. So with that, I would just turn it over to Nick and say, Nick, the floor is yours.
All right. Thanks, Mike. Thanks to everyone. As a matter of fact, I just had to shoo my children upstairs. So hopefully my admins, as I call them, don't come down and interrupt us. And as you see, I'm in my makeshift home office. I promise you the views from the New York office are nicer than my basement office with my young daughter's little kitchenette system that they put up. But in any event, I'm glad to be with you. I certainly would rather have been in Salisbury University. It would have been a nicer backdrop. But therein lies the reason we're here. And I guess the topic for the conversation and why I think what we talk about today and the subject matter is that much more important and prescient, right? And what I want to talk about, and Mike did a great job teeing this up, is sort of the path, in our opinion, that we've been going through over the past 3-4 months, where we are today within that path and what the path forward then looks like, not just over the next 6 to 12 months, but perhaps over the next 6 to 12 years as well. And yes, I am an investment strategist, so I do take a market lens when I also look past the economics. And from that perspective, I'll also talk about how we think we can capitalize on it from an investment perspective, even though I know that might not be what everyone's focused on pertaining to commercial real estate and such, right? Well, I'm going to take that sort of lens, right? So from our perspective, if you outline the path that we believe we're on, there's really 5 phases. We call it the great separation, right? There's the liquidity phase. I'm going to get into all of these. There's the bridge or economic buffer, the economic recovery, the pent-up demand cycle, and finally, the new frontier. So we're trying to get through all of that, right? When I was first setting up this conference, we didn't even know what COVID was at that point. In fact, it wasn't called COVID. I don't think it was called COVID until like sometime in March. It was a coronavirus, it was a Wuhan coronavirus. And then it turned our world upside down, right? I typically, when I do these conferences, I'll have a nice PowerPoint deck. Spoiler alert, our compliance makes us plan those things months in advance. But now these days, we can't even have anything to necessarily any collateral out there that we can promote as slides, because the data is changing, not just on a monthly basis, but on a daily basis, right? The world is changing before our eyes, which again, increases, I think, the value of us getting out there and speaking, and increases the value to us for speaking to clients and speaking to folks out there who can tell us what they're seeing in their own communities, right? So if we take a step back and think about where we've come from, right? We started this journey really in late February when the market was at a high. Coming into the year, actually, we were starting to believe that the whole global economy was recovering. We thought the global economy was picking up steam and it was going to have what we were calling global synchronization of growth. Right? The US had been doing well. It was going into an election year. Wasn't any thoughts of stimulus on the horizon, but we thought that with a phase one trade deal with China, remember the trade deal? We thought that was actually going to be good kindling to see an economic revival here in the US, but even globally. And that was playing itself out. That's the problem. That was what our call was. And we were right. It was starting to play itself out through the data, but then the coronavirus. Then what happened was, we had a global pandemic that totally threw everything for a loop and turned this all upside down, right? And that really began in late April here in the US. And if you think about it, as a matter of fact, at that point, the stock market, right, even the credit markets, the bond market, the capital markets, they were actually lagging the actual disease. They were lagging the virus. They were lagging in many effects the economy, which typically doesn't happen. Typically, assets are leading indicators or markets are leading indicators. That wasn't happening, right? If you remember, the US stock market hit an all-time high on February 19th. By that point, there were cases here in the US, and you had sort of the markets whistling past the graveyard, right? You still had markets that were focused on things like the phase one trade deal and growth, and they kept grinding higher. However, that all came to an abrupt halt, right? The end of February into March, really culminating at the market's bottom, which was March 23rd. What you had was a really sort of a come to Jesus moment, if you will, from market participants that, wow, this is big, right? COVID-19 is here. It burst on the scenes. What you had then was a period of peak fear. You had an ultimate sudden stop of the US economy, a sudden stop of the global economy. And the fear then started to morph. It started to morph into something more of just an economic recession or an economic disruption into an actual financial crisis, into a liquidity crisis, right? You had solvency risks for good companies that really started to spike. If you were a solid investment grade rated, big, good company in the US, and you tried to come to market in March and issue bonds, good luck. It wasn't going to happen. The financial markets started to seize up, let alone high yield companies, but even good companies, they couldn't access the commercial paper markets, right? That's when the stock market really fell off a cliff. Again, we hit our market bottom on March 23rd. But again, what you saw was this idea that an economic downturn could permeate into other areas of the global economy, but also the global financial marketplace, and really create something akin to 2008, 2009, right? So that was this idea of liquidity crunch. This is where you got peak bearishness too, right? This is where all the economists that I work with, right, they were sort of in a rush to fall over themselves to downgrade one another, right? So if you think about it, Bank of America Merrill Lynch, our chief US economist, right, she initially had a projection for GDP growth in the second quarter of negative 10%, which is, by the way, that in itself is massive. Okay, negative 10% would represent the second worst quarter in US history. But then we downgraded from negative 10% to negative 40%. I mean, that's unreal. You don't see that. Goldman Sachs, if you looked at what they were projecting, they were off by 10, 20%. All the major sell-side research firms out there, any economist you ask, they weren't quibbling now over a 1 percentage point or a 2 percentage point difference. All of a sudden, they're quibbling up over 10, 20%. That's unheard of. Again, usually in a good year, I'll disagree with another economist on whether or not the U.S. should grow at 2% or 2.1%. Now we're disagreeing about 20%. I mean, it's unheard of. You had never have you seen a period where there's more discrepancy, more dispersion and variation between expectations from economists, also from market strategists, right? If you ask someone what the S&P 500 was going to be in March, you might as well throw a dart at a dartboard, right? So this was peak fear and it built itself up. That's why, again, you saw a bottom in March 23rd. It's when every investor you could talk to, they were selling anything that wasn't bolted down. You probably, many folks on the line probably saw this in their own lives. Maybe you spoke to your advisors about this, right? We have something at Merrill Lynch called the Bank of America, Merrill Lynch. It's called our bull bear indicator. And what this bull bear indicator does is it takes an amalgamation of various contrarian sentiment indicators. So what it does is it looks at how hedge fund managers are positioned. It asks how retail investors, the mom and pop investor, how are they feeling about the markets? How are they positioned? It talks to mutual fund managers. So it takes all these different, investment participants, and it articulates what the average sentiment out there is. And it's a contrarian measure. So basically the intuition here is when everyone is telling you to buy stocks, like when your dentist, your dog walker, your neighbor, they're telling you to buy stocks, go get risky. That's usually when you want to look the other way, right? And the alternative is when everyone's telling you get out, sell, no matter what it is. And people are trying to sell anything that's not bolted down, which happened in March. Well, that usually represents a good entry opportunity. You want to zig when others zag. I don't know if anyone on the line is a fan of Seinfeld. I guess I'm dating myself. I'm only a millennial here. But Seinfeld, there was an episode called Do the Opposite. And George Costanza, sort of the lovable loser of Seinfeld, he realizes that his intuition is always wrong. So maybe if he does the opposite of his intuition, he'll be successful. So, at one point he sees a beautiful woman at a restaurant, and he says, everything is telling me not to approach her and talk to her, but he says, you know what, I got to do the opposite. So he goes up, he says, hey, my name is George, I'm unemployed, and I live with my parents. And, she turns around and says, hey, I'm Veronica, and they date, and that's it. So sometimes as investors, that's the same for us. You want to do the opposite almost of what your gut instinct is. And that, if you acted upon that in March, that was actually a very, very, that would have been very profitable for you. But this liquidity phase was really, it was abrupt, but thankfully what you saw from policymakers helped to end it, right? So the Fed stepped in, more or less all of Washington stepped in, right? The fiscal authority stepped in, and they didn't do necessarily this to save the stock market per se. They did it to arrest any of this financial stress out there. They just want to make sure, not necessarily that assets are propped up. They want to make sure that companies can stay solvent, right? If you're going to save the economy and save jobs, well, you better make sure that there's companies that are going to be, that these folks have jobs to go to work at, right? So what the markets then realized was that the Fed and all the fiscal authorities and the stimulus that had gone into play served as a backstop, not just to the economy, but also to markets. So at its trough, the U.S. stock market lost, $12 trillion. That's like $37,000 per American, right? The equivalent of which was lost at the bottom. That's massive. And that has a wealth effect, by the way. So if anyone's sitting at home, if you might say that the stock market is not necessarily the U.S. economy, but at the end of the day, if you're looking at your 401k or you're looking at your house value, you're looking at your retirement funds, and it took a 30% haircut, you're feeling a little lighter in the pocket, in the wallet, than you did prior. So like it or not, this idea of a wealth effect of assets does have a massive effect on consumption, which is 69% of the U.S. economy. So, the Fed and fiscal authorities, when we say that they did prop up these markets, yes, to some extent, the whole idea of don't fight the Fed, but at the same time, that does help Main Street as well. So that was that liquidity phase. And now we've moved over to the bridge, and the bridge is when you're living in the depths of the crisis. And you're in that sort of not just a medical bottom, but the economic bottom. And I'd argue that we're just starting to emerge away from this. So if you talked to me in late April or May, I would have said we were right in here. And this is where you're living the worst. You're living the trough. So think about this again. I told you the stock market bottomed on March 23rd. Well, think about March 23rd. That wasn't when we were at the peak critical condition from a medical perspective. That wasn't when you saw the most hospitalizations or, unfortunately, the greatest mortality. We're still working through that. No, the peak medical capacity strains occurred in April, right? But the market, is a leading indicator. As I mentioned earlier, the market in January and February actually was whistling past the graveyard. It wasn't even, it was not concerned with the coronavirus, but then it's totally shifted. And by March, the market became a leading indicator. That's what I would argue you're seeing today when folks ask me, why is the stock market doing so well? Meanwhile, the economy looks like it's still as shaky as can be. And of course, we haven't solved the health crisis. The market is a forward discounting mechanism. It's looking past that. And we can get into that later. But what you've seen now is that period we call the bridge, where again, you're living the depths of the crisis. And all of a sudden, you look around and you say, we're going to get through this together. Right. So in April and May, was it fun to be locked up in your house? Right. Was it fun for me to be locked up here with my two young children running around and all that? I guess I should say yes, but in reality, sometimes it's not always the most fun. But you live it and you realize, if you had told me in January or February that I couldn't go to a restaurant or a bar for 3 months, I don't know if I would have thought I could make it. But here we are. And then you're living it. When you're going through it, you say, you know what? Not only is it not, as bad, but now I know, now the fear, now the uncertainty is taken away, right? So that's what you went through. So as the negative data continued to build up, and believe me, the data that we saw in April and May, absolutely shocking, right? I mentioned earlier, Bank of America, Merrill Lynch, our expectation for second quarter GDP growth here in the US, right? Now it's negative 40%. Quarter over quarter. I mean, that's unheard of. The worst quarter in U.S. history was about negative 10.5%. I want to say that was 1954. So we're going to be breaching that by orders of magnitude here, right? But while you had this negative data build up, what you saw then were the policy responses. They continued to come and build up. So right now, as we speak, right, there's about 45% of U.S. GDP committed to stimulus from both the fiscal and monetary side. So what do I mean by that? So if we say that the US economy prior to COVID was $21 trillion on a given year, right? About 45% of that, the equivalent, has been committed to jumpstart the economy or to backstop markets, right? Now, all of this money, it's not just debt. It's not that. Some of it is going to be paid back. Some of it is liquidity lines, right? So credit lines offered to commercial paper, to high yield debt, that sort of thing. But I mean, that's unheard of. And there were periods where there was a lot of headline risk as it related to some of the stimulus programs, maybe PPP, folks didn't get their money quick enough, this and that. And there were some anecdotes of trouble, but at the end of the day, there were two goals from a policy perspective: A, get the support out quickly, and B, do a lot of it, right? It was less about, it was more about shooting first, asking questions later. And, by and large, looking back, I think fiscal authorities and monetary authorities have done a pretty good job, right? We'd argued that the Fed did more work in 2 weeks in March than they did in 2 years in 2008 and 2009, right? So that was certainly a positive. But still, the data that we see and we had seen did come in extremely poor. I mean, the global PMI, that's manufacturing activity, it dropped to 26 in April. I mean, that's the equivalent. That's usually consistent with -9, -10% GDP growth. I mean, that's unheard of. These are unheard of drops on a global basis and a U.S. basis in terms of activity from both a supply and a demand perspective, right? From a supply perspective, you just don't have. You don't have businesses that are open. You don't have companies that are open. You don't have manufacturing that's open. And then from a demand perspective, even if you get people back to the factories, even if you get people back in the offices, is there anyone out there willing to go buy the product, right? That was the challenge. But now we are starting to get past that. You're starting to see the economic recovery. And that's where we are today, the economic recovery. And by the way, that's where you start to see the market look past that poor economic data and start to look forward to what recovery looks at. Start to look forward to what's on the other side. So as I mentioned, right, that bull bear indicator that we had showed extreme pessimism in March and April. It hit zero, literally the lowest level possible. The last time it hit zero was during the great financial crisis, right? So what you saw were investors, whether it was the quote unquote smart money, the hedge fund managers, or whether it was the retail folks, you and me, everyone was sitting out, everyone was selling. They were getting out of the stock market. They were going to cash. We saw the greatest inflows to money market funds on history. We saw the greatest outflows from even bond funds in history. Everyone was selling anything they could to go into cash. That has now started to ease just a bit. And that's good. So what does it tell me? Well, from a market's perspective, it tells me that if the equity markets, the US stock market, for example, if it was able to rally to such an extent that it already has, I mean, it retraced almost 80% of what it's lost. We're almost even for the year in the stock market, right? If it's been able to do that with pretty much every investor still hating the market and sitting out on the sidelines and all that cash still out there, that's really good. Because what it tells me is that with all this money on the sidelines, that's money that can come back into the game, right? So that's important, right? That's very important for us to look at. So now, the question is, what does the recovery start to look at? As I mentioned, we expect the second quarter to be by far the worst that we're going to see here in the US. Going forward, we expect to see, you can call it a V shape, if you will, but we prefer the idea of a square root shape recovery, right? So in the third quarter here in the US, we expect GDP to grow 7%. Fourth quarter, 12%. So for the full year, it's going to be a bad year, spoiler alert, right? The worst is behind us, but we do expect the US economy is probably going to contract by 8% this year, 8.1% negative contraction this year. However, next year we expect the economy to grow by 4%. And then in 2022, also to keep up this pace, start to claw back what was lost. And I think that's going to be the major question. That's what folks should concern themselves with going forward. How much of the lost output in the economy do you claw back going forward? So what I mean by that is, a lot of this, we call it demand destruction, or a lot of the economic disruption, it's not just lost forever. It didn't vanish in thin air. No, it's going to, hopefully we'll get some of it back. So, if you're sitting out there and you needed to buy a new pickup truck or a new refrigerator or a new air conditioner or couch, whatever it may be, during the pandemic, you're probably not buying that air conditioner or the refrigerator or the couch, whatever it may be. You're probably not doing that. But once it's safe to go purchase those goods, you're probably still going to need that new truck or the new couch, whatever it may be. You're just delaying that consumption. So the question is, how much of what was lost can be clawed back? And I think what you're seeing now are economists and strategists like myself that are starting to say, maybe you get a higher proportion of that lost demand or output start to get clawed back. So some estimations are that 75% of what was lost over the past couple of quarters can be gained back. I take a little bit more of a conservative approach and would say maybe you get 50 to 60% of that. But the key here is you're starting to see folks, economists, strategists like myself, who in March, it was like a contest. Who can downgrade one another? Here's a lesson they teach you on Wall Street when you get here, right? To maintain your career, you usually don't want to be wrong, but you certainly don't want to be the only person that's wrong. You don't want to stick out like a sore thumb and be wrong for it. If you're going to stick out like a sore thumb, you better be right, because that'll either make your career or break your career. So it's, sort of career maintenance to do what everyone else does to that whole groupthink idea. So, if you're an analyst, you're an economist, you don't want to be the person that looks like, you're holding the bag because you're the one optimist left. So in March, you had just a sea of downgrades. You had folks out downgrading one another because you can't model this. You couldn't model a pandemic. No one accounts for what negative. No one accounts for what zero growth is going to be, right? If you're a restaurant, maybe you plan for 20% loss of your customer base. You don't plan for 100% loss of your customer base. It's unheard of, right? So that's why my industry, which a lot of times we rely on quantitative models. In March it went haywire. The uncertainty had never been higher. Now, however, you're starting to see things settle down. You're starting to see economists and strategists say, maybe it's not a V, quote unquote V, but maybe it's a U. Maybe it's a V. We're calling it a square root type of recovery, and that's where we expect to see this broad-based turn up of the data that we're seeing, but also eventually a post-recovery or a post-recovery pent-up demand cycle where all of that demand that had been lost begins to get clawed back. And I think that's where you're going to see it. So we do expect that this is going to be remembered as the deepest recession in U.S. history. Okay. The sharpest, at least. However, there's a very strong chance it's also the fastest recession in U.S. history. What I mean by that is traditionally a recession had to be 2 consecutive quarters of negative growth. We might not get 2 consecutive quarters. We might only get maybe 4 months or 5 months of negative growth, but then a sharp rebound. That's actually what our base case is. I don't know if you want to call it a V shape. We like to use that square root term, but we do think once you get into fall, you can then begin to see that pent-up demand cycle start to take place, and really an explosion of an economy really getting its wheels back on and picking up momentum into the end of the year, into 2021. And that's finally what brings us to the new frontier. And that's the secular idea of not what the world looks in 12 to 18 months, but what does the world look in 6 to 12 years, or what are some of the lasting secular changes that you're going to see? And, the big questions are, will there be just a total destruction of demand? Are there going to be folks that, and we were talking about this before the call, are folks going to, are we going to go back to a New York skyscraper anytime soon? Or is this going to be the quote unquote right sizing of office space? And, I'm not a commercial real estate expert. Many folks here probably have much more enlightened ideas upon that, but these are questions that have to get shaken out. But what I would say is what you can look at are themes such as the new tech spend. In our opinion, one of the bull cases to come out of this is this idea that you need a total new, not only an onshoring of manufacturing and production, but you need a new capital investment cycle. So if you look here in the U.S., our physical capital portfolio is the oldest it's ever been in U.S. history, right? You need you need investment on a capital basis into property, plants, and equipment. The only R&D spending we've had in the past 20 years, it's been to software, basically. It's been very concentrated. You need spending, capital investment back into America, back into business. And in our opinion, this is a great opportunity, right, to see a refreshment, to see a new cycle of capital investment really take hold. And some of that will, again, be prompted by this idea of onshoring. Some of it's going to be, due to friction, of course, with China. But some of it also just be this idea of building redundancies. I think that COVID has certainly exposed a real hole from a strategic perspective, not only of countries, but of individual companies, right? If there's a pandemic and you can't get access to your people or your goods or your clients, you're at a loss. And again, that's where you're really exposed. So the idea of building redundancies, I think, will also help hasten this idea of a new refreshed investment cycle starting most likely in 2021, right? There are some worries, however, right? One of the worries is the idea of higher taxes going forward. And I'll talk about the election in a bit. There's ideas of peak capitalism, if you will. That's something that's been bandied about. The idea that, that the system itself needs to be changed. And that's a risk. Happy to talk about that when we get to the election. But these are concerns over the long term that could be, that I think will drive the conversation. Also a higher savings rate, right? One of the, before the coronavirus, for the crisis, the US savings rate was pretty high, actually. It's about 8.5%. And most folks, if you think, or ask some people on the street, if you said, are Americans saving enough? They'd probably say no, Americans aren't saving enough. People have heard the stat that, there's some percentage of Americans don't have enough money to meet a $500 medical emergency. Okay, I get it. However, the aggregate savings rate in America is pretty high. The aggregate balance sheet of the U.S. consumer is was really strong, right? So if you look at, think of what your mortgage rate is these days, right? It's low, right? Americans now are wealthier. They have the same amount of debt. However, the ability to service that debt has dramatically increased. Again, the interest rates on that debt have lessened as incomes have risen and as your wealth has risen. So, it doesn't matter what your level of debt is if your level of assets have increased at a dramatic rate, and if your ability to service those debts has increased. And that's what we saw. We were actually making the case before the viral outbreak that Americans could actually save less and actually take on a little bit more debt. And that was one of our bull cases going forward on a secular basis. The fear that we do have now is, does this economic calamity result in a larger savings rate going forward, right? The hope is that that's not the case, but that's something that remains to be seen. So we'll keep an eye on that. right? Right now, the savings rate ticked up in April to 30%. That's a record. That's by far, that's a lot. And it makes sense, right? If you don't know if you're going to have a job, right, you're going to save. Also, if you don't, if you can't even go out and spend, of course you're going to save. You don't have anything else to spend it on other than, Amazon deliveries, if you will, right? So that's, those are some longer term concerns. I mentioned some of the data that we're looking at that does show the economy is getting back on solid ground. At the end of the day, really what you need to look at is the U.S. consumer. Okay, that's what's going to, the U.S. consumer is 69% of the economy. And what we're seeing now are confidence surveys that are bottoming out and starting to pick up. And especially future expectations are starting to pick up. So it's not a surprise to anyone right now. Most consumers, they don't feel so confident about their economic position. They're feeling better this month than they did last month. But the key is their expectations going forward over the next 3 to 4 months have dramatically improved. So what you're seeing are consumers, right, even in the face of large job losses, feel like their individual economic position is going to pick up in the next quarter or so. Same thing with small businesses. You're seeing small business optimism picking up, not necessarily, again, in their current situation, but in their future expectations. Home builders, right? The home builder survey just jumped 21 points this morning. The NAHB home builders sentiment jumped 28 points. The expectation was for an 8% increase. It blew it out of the water, 28 points higher. PMIs. So these are surveys for manufacturing. Globally, they've picked up dramatically. Here in the U.S., they've stemmed the declines, and also their future expectations have picked up. And then there's the hard data, right? A new interesting data set has come out from Apple, right? They have this Apple mobility tracker. Basically, it tells you where people are traveling, the level of travel activity and mobility in the U.S. It's kind of scary, actually, to some extent, with what goes on from a health perspective, but right now, travel activity is back up to February levels in America on an aggregate basis. So you're seeing people are getting out there again, right? I mentioned the savings rate here in the U.S. soared, but also real incomes, real disposable personal income has soared. $17 trillion, right? $17 trillion has been added to the personal incomes of Americans during the pandemic. And you'd say, how the heck can that happen with job losses? Well, a lot of what you saw from a policy perspective helped to stem those losses. You're seeing now even retail sales, they picked up. That's why the market did so well yesterday. The retail sales figure exploded almost 18% in May. It was the greatest, it was the largest month over month increase in retail sales. It's also the biggest surprise, right? What you've seen again are economists and strategists. They don't know, what to expect anymore. You can sort of throw the data out the window. The amount of the degree of misses of economic forecasts has just increased to a tremendous extent. So more or less, the data is showing improvement, right? We saw good jobs data a couple of weeks ago with the pace of declines pace of decline slowing, and then even the housing market, right? Obviously, we know of low mortgage rates, but the pent up demand for housing has picked up. Mortgage applications for purchase, so not refis, but mortgage applications for purchase, they increased 71% from their April lows here in May. I mean, that's massive. So this idea that the consumer and that business won't get back to normal or take that much longer, it's not necessarily playing itself out in the data. We're seeing a really sharp rebound. Now, the question is, can there be a dip? Can there be a double dip? What if you have a second wave? What if anything else comes up to derail this recovery? That's something that remains a risk. And from our perspective, from a market perspective, it would not shock us whatsoever to see a small correction or two going forward. I think the bar has certainly been raised higher to be able to continue to impress with positive data. I think a lot of the low-hanging fruit has already been harvested. However, at the end of the day, you still have that policy, right? Again, in the U.S., you've got almost 45% of GDP committed to stimulus. I mean, the fiscal policymakers on Capitol Hill and also in the Eccles building in the Fed, they are committed right now to make sure that they'll do whatever it takes. It's really, I'm not even going to call it a Fed bazooka. It's more like a Fed nuclear bomb. They're going to do what it takes to make sure that the economy can continue to recover and to chug along. So the next steps will be, we're going to look for more fiscal stimulus, right? We expect there to be an additional push for a plan. It looks like I know Democrats want to get a plan of in excess of $1 trillion. Republicans seem to be balking at the price tag. Most likely, our sources in DC do tell us that you'll probably get something, and it'll probably get closer to $1 trillion. Obviously, some of it's going to depend on what's in the actual bill itself, but that would obviously continue to be stimulative. Some of it needs to be done, whether it's extending PPP loans and replenishing the funds, but also, you need state municipal aid. Then you need ways to help usher in return to offices with business liabilities and things to that extent. So we're going to continue to look at that. And then finally, from a market perspective, what we're seeing is confirmation, right, that the economy does seem to be picking up speed. So again, the market's the leading indicator. And if it was just the Googles, if it was just the Netflix, just the Apples and the Microsofts that were flying and doing well, I tell you, all right, this doesn't tell me much, because those companies, of course, they're prospering during the pandemic and they'll prosper otherwise. However, when you start to see value stocks, for example, when you see cyclical sectors like industrials, when you see oil prices, commodities, when I see iron rebar and copper, Freeport-McMoRan, I see some of these companies and some of these assets that are tied not necessarily just to secular growth trends like technology or mobile commuting or whatever. No, when these companies that are really very closely tethered to economic growth, when they're doing well and they've started to, what that tells me is investors are buying an actual economic recovery, right? So that's important. That is certainly important, that we'll continue to look for. So I've talked a good amount at this point. Why don't we stop there and maybe open it up for Q&A?
Hey, Nick, great job, man. Very thorough. It was actually a little refreshing to listen to some stuff that's not commercial real estate focused. So thanks so much for all of that information. So I jotted down just a couple takeaways while I was also monitoring the questions and trying to listen all at the same time. But just for the audience who may not have been taking notes, your company's original projected GDP was going to be negative 10% growth, but that was quickly revised up to now and currently standing at negative 40% growth. The sharpest recession we've ever seen, but we're also going to probably experience the shortest recession. And that's even if we technically even get into the textbook definition of a recession. Time will tell on that. And then you echo our last week's speaker, Annabelle Massou, where we're already in a recovery. And I think the data shows that. So I have my own personal question that actually comes from your company's projected GDP negative growth. And so we had a question that you already answered. So I put that in the question and answer box as answered, which was, the market's forward thinking. That was the answer of why the market's doing well, but the economy seems to be suffering. So my question is how will the market react if and when the GDP does come in near or at that negative 40% growth? If that number's already been talked about, it seems to me, just from maybe the non-stock market professionals, that once that number does come out, if it's, say, just even close to that number, it seems to me we're going to have, I don't know, a sharp downside. What are your thoughts on that?
Yeah, it's a great question, because again, it goes to the concept of what's priced into a market and what's not priced in, and it's obviously you never know what's fully priced in or otherwise. To our economists or a professional trader or a money manager, economic data they see, if it comes into close to what the expectations were, it really shouldn't be a shock to them, right? They should be expecting that. But to, Joe Sixpack or you're me or you or a retail trader who doesn't necessarily know what they're looking at, you see some of the numbers and you shake your head and you say, wow, this is bad. I see 40 million Americans unemployed, or we see GDP that's negative 40% in the second. Again, that's the second quarter. So I'll caution you that annualized second quarter. For the full year, we only expect GDP only to decline by 8% year over year, but that's still obviously very significant. So I do think there's headline risk out there, and what I would expect to see is this to actually increase opportunities for a long-term investor, because what you would see is those retail investors, folks that are not necessarily that are not necessarily in tune with what consensus expectations are, they're going to see the numbers and say, wow, I'm going to shoot first, ask questions later. I got to sell. I can't hold stocks if I see the data come in this poorly. Meanwhile, you'll have, the astute investor that'll say, heck, I expected that anyway. And this is old news to me. Again, and also that's important to mention too. That's backward looking data, right? So that's why I say you can almost throw out a lot of the data that you see. And I look for more of these future expectations survey type data, because a lot of this is backwards looking. And in these days, data is not stale last year. Data is stale last week in many respects. Data is stale last month with all the moving parts here. So we do have to focus on what is going forward from that perspective. Let me also just mention one quick observation that we've seen recently, and some folks may have seen it. There have been pockets of speculation now in the equity market. Robinhood, for example, right? I don't know if anyone knows of Robinhood. It's the free trading app. You can look at the activity on Robinhood, and since March, there's almost been a direct, a negative correlation. So as the market had gone down, more and more people were opening up these Robinhood accounts and buying basically the junk out there, buying the Carnival Cruises, buying the companies, the airlines, companies most affected. Why? Because what do you learn in Finance 101, or even, in high school? You learn buy low, sell high. And what we see are investors that are chasing, the retail investors that are chasing names that really probably you might want to avoid. So you do see a little of that speculation out there, which is concerning. And to your point, I think if they do see data come in that's shocking, they might say, "What the heck did I get myself into?" Yeah. The only other point to this question I'll make too is, at the end of the day, also, if you're an investor, you have a limited opportunity set of where to invest, right? Generally speaking, and I know this is a commercial real estate forum, so commercial real estate you can invest in. You can invest in stocks, you can invest in bonds, or you can put your money in cash, right? And what are you going to earn with cash? Zero, right? In theory, with inflation, you actually lose money with cash. That's fine for some folks. They're fine with locking in a negative return as long as they know it's a small negative return. What about bonds? What does a 10-year U.S. Treasury get you these days? Nothing. 78 basis points, not 1%. Even investment grade bonds. Right now, the S&P 500 has a higher dividend yield than the overwhelming majority of even investment grade corporate bonds. So what are you left with? Stocks. And when I look at valuations of the U.S. stock market, does it make me feel warm and fuzzy? No. But if I'm an investment manager, or I have to put money somewhere, if I'm the CIO of the Norwegian Sovereign Wealth Fund, or a pension, or an endowment, right? At the end of the day, I have to invest and I need a return. If I run the endowment for Salisbury University, I need to get a return, right, for operating costs. I can't just put it in cash. I don't have that luxury. I can't just put it in bonds. I need a return. So at the end of the day, as much as you want to sort of hold your nose, the equity market, especially in the U.S., in our opinion, large cap, high quality growth and yield, yielding U.S. large cap stocks are the best positioned in our perspective on a global basis from an asset allocation perspective. So hopefully that also gives you another point there.
Thank you, Nick. Another question we have from the Q&A box is, in commercial real estate, obviously financing is a key component of the deal. And one of the questions is what do you expect the trajectory? What do you propose the interest rates are going towards? I can't even say that word. And what do you find as the availability of financing as well? Forecast.
Yeah. So this is one where it's a bifurcated answer, because of course, so from a policy rate perspective, we know the Fed has basically telegraphed, they've laid their cards out on the table and have said, we're not raising interest rates anytime soon, right? So what does the Fed control? Obviously, traditionally, they control the short end of the yield curve, right? The Fed funds rate. And if that's going to be zero for the foreseeable future, and by the way, I don't think it's going to go negative. It's sort of it's a well-known secret within the Fed that they don't believe that negative interest rates are a good policy, right? We've seen what it's done to the European and Japanese banking systems. So we'll just say the Fed funds is going to stay at zero. The question then is, what are longer term interest rates? So, the 10-year treasury yield. in our perspective, we don't expect to see a rapid increase anytime soon. So if we end the year with a 10-year treasury at 1.25%, that's probably in line with our expectations, and then a grind higher from there. Now, there's going to be some technical resistance levels because, again, as I mentioned, one of the reasons why the stock market's doing so well and it's so richly valued is because of this idea of TINA. There is no alternative. So once you do start to have a little bit more yield in other asset classes and increase that opportunity set, there would be capital that comes off the sidelines to be able to benefit from that and push, help create a little bit of a natural ceiling on rates. But we do think that they will begin to recover as the global economy recovers. So the 10-year yield, for example, that's going to be more, that's going to trade more in line with what growth expectations are. And we do expect those to pick up over the next year or so. And it's also going to be in line more with inflation expectations. And we don't expect inflation to be a problem, but we do think that the Fed is doing everything it can, and really even policymakers at Capitol Hill, they're doing everything they can to create inflation. So, the odds are certainly higher that we see higher rates rather than low rates. The question is, how rapidly do rates rise? And I don't think it's going to be rapidly at all because, again, you have all that capital out there that is starved for yield and that will come in and bid it down and create a bit of a natural ceiling there. So cheap capital is going to be something that's going to be the way of life for us, I think, for the next at least 3 to 5 years. Perhaps it's not, quote unquote, free money, but I don't expect to see dramatically higher financing costs anytime soon.
Thanks, Nick. Yeah, we're seeing and hearing the same things from the folks in the capital markets world. I know one thing I'll touch on, you mentioned something about there's been a lot of investors opening up these free trading accounts, trying to go after the low-hanging fruit, use a different analogy. But the strong companies, or the previous strong companies that have taken a hit and try to take advantage of their bottom, we're seeing the same thing in the real estate market. I'd say my investor list has grown twofold on the number of people looking for all the same thing. They want that troubled asset, which of course can't be labeled right now because banks aren't able to even, mark those assets really as troubled assets or really go through that foreclosure process at the current time. So that really doesn't exist right yet. It's a little premature, but every single person in general in our market is looking for the same thing, that low hanging fruit. Everybody's fighting over the same thing. I had a property that we had a listing agreement on, never even was able to even take it to the market because the word got around so quick. This is the second time this has happened, by the way, that word got around so quick that in each case we had multiple competing offers. And it was all based on that same theory that you just described in the stock market that you're seeing. So that's interesting correlation, I guess, between the real estate market and the stock market there. We've got a lot of questions that have come in. We're going to run out of time before we get to all of them, but here's one that's relevant in the times that we're in today for sure. What are you guys, let's see where it is. There it is. What impact on the economic outlook and the markets does the upcoming election cycle have? I know that's a question that you get asked every 3 years while the campaigning gets restarted again. So what are your thoughts on that in this cycle?
Election? We have an election? Yeah. So, in January and all of last year, I had to become more of an expert on U.S.-China trade and more of a political analyst than I am an investment analyst. That's all anyone wanted to talk about, obviously, was the election and U.S.-China. And it's funny how, it's funny how we are now 4 or 5 months beyond that, and you're starting to hear that come up again. And that's actually, when folks talk to me about the stock market seeming like it's a little bit overvalued, I can understand where they're coming from when, we haven't gotten past the election. We haven't gotten, in fact, I'd argue the risks have risen. We haven't gotten past U.S.-China trade frictions. And by the way, there was this whole pandemic in between, but we sort of are now at the same place we were beforehand. I get that sort of thing. Now, from an election standpoint, obviously, putting aside social issues, putting aside our politics, I check that at the door, and we all do from a professional standpoint. The risks from an economic and a market perspective that clearly bubble themselves up would be, taxes, obviously. would be regulation, right? And the hopefully the fruit or the offset would be stimulus, so perhaps infrastructure, higher spend. And what we hear from our sources on DC are that, well, I don't have to tell anybody on this webcast that, clearly the odds of a Democratic administration in the White House have risen incredibly, as have the odds of a Democratic sweep of both chambers of Congress. So right now, if you look at the predicted odds or the betting market odds right now, they're now favored to see Democratic control of both chambers of Congress and then also the White House, right? So now you can get stuff done, right? From a policy perspective, if that's the case. So from, again, just an economic and a markets perspective, checking our politics, just from what we've seen, there are some policies that have been proposed from candidates that would, in our opinion, be deleterious to the market and the economy, at least in the short term, right? You raise corporate taxes. I don't care how you slice and dice it. Just math is telling you that your earnings are going to be less. So now, what I will say, however, I do believe some of the risks here, and from a Biden perspective, he's proposed raising the rate to 28%. Some of the risks are overstated. Talking to the folks in my industry and investors, they believe that rates would go back up to 35%. It's not going to be like that, right? Again, candidate Biden has made it clear 28% was sort of where he wanted to go with it. And then once you get to the negotiation process, maybe you get somewhere closer to 25%. And I believe Nancy Pelosi was closer to 25% herself. As a matter of fact, even before the Republicans were able to enact tax reform on a bipartisan basis in DC, it was like a pretty poorly kept secret that both parties wanted to lower the corporate tax rate. Like, it was pretty obvious that corporate taxes here in America and our tax system was incompatible with the rest of the world. So everyone wanted to get something done. It was just a matter of which party could get it done, and the other party was going to sort of hammer at it, and then the individual tax reforms on the side. But taxes, most likely from a corporate perspective, would it be at risk of going up, at a certain percentage. I don't know if the worst case scenario that some folks are pricing in would, or some folks are expecting, would necessarily wind up taking place. On an individual basis, that's going to have less of an effect, of course, on the markets, more of an individual effect. But you start changing capital gain taxes, you could affect liquidity of the markets. There have been some radical proposals that have been bandied about, which would index capital or would have capital gains be realized on an annual basis. I think those are even unrealized capital gains on an annual basis. Those policies seem to have less traction going forward. As I mentioned, from a regulatory standpoint, we would expect regulation to pick up in the case that Biden would win or Democrat would take the White House. If not through new regulation, at least through just the pace of no more deregulation, if you will. The current administration has really rapidly removed regulations. So even if a new administration came and didn't touch anything, they wouldn't be deregulating most likely. So that would be a net loss from that perspective. From just a market, how the markets may view this. But I mentioned the upside is stimulus. The upside is infrastructure. I think candidate Biden wants to get infrastructure done. The Republicans want to get infrastructure done as well. It's a matter of who can get it through, who can push it through the finish line. So the risks have certainly picked up. And as we get closer to November, the risks will only intensify further. However, I think as is the reality these days in politics, the worst case scenarios proposed by each side are probably, it's probably somewhere in the middle. It's probably not as bad as the dire situations that maybe some might make it out to the scene.
Thank you, Nick. We have another question from Mike. A regular recession, quote unquote, was predicted and forecasted before COVID-19. As we rebound from this COVID recession, how do we calculate what a normal, quote unquote, economy looks like?
Yeah, it's interesting. There were a good amount of people did feel like the economy was running on fumes, or it was being supported by debt, or it was being supported by, the tax bill, for example. Personally, I never necessarily agreed with that. I did think, and our house view was that the economy was actually going to accelerate this year here in the U.S. and globally, because we did think that we thought the economy did very, very well in 2018, 2017 as well. In 2019, we felt the economy had become a little bit more sluggish, not because of anything that had to do with a weakening consumer or weakening business investment, but it was weakening because you sort of are shooting yourself in the foot with a trade war and the uncertainty and the confidence. And once we start, that's the problem. That's the shame here is come December, we finally got over that hump. We got rid of the trade war. When I would ask business owners, for years, I always ask, what's the biggest concern you have as a business owner or as a client or as a consumer? The question for the answer from business owners used to be that taxes were too high, or that regulation was too high. There was too much onerous regulation. Now the answer I got was that it was too difficult to find quality labor, right? Business owners would tell me they couldn't find anyone of quality to take on these jobs. And then I ask them, what are you looking to pay that person to drive a $200,000 piece of equipment? I don't know, $10 an hour. Good luck. It's not going to work, right? So what we were seeing, the economy was still strong. The labor market was still strong. We didn't necessarily, in our opinion, see the impetus for a recession or decline. Now, it was the longest expansion in U.S. history, but it didn't have to die of old age. This was an exogenous shock. So what I do think, though, is this does give us an opportunity, right? Unfortunately, it took a crisis to create it, this opportunity. But, they always say, never let a good crisis go to waste. I do think this ultimately does give us an opportunity to reset the clock, if you will, and to maybe correct some imbalances that were percolating. But, again, at the end of the day, I still think it revolves around the U.S. consumer. And if you can get the U.S. consumer back employed, wealthy, and confident, that's it. That's the end game. The problem we had over the past cycle was that we didn't have business investment that would follow through. If we do get that business investment to follow through, and I expect it to happen, then we can say that, yeah, we now have a stronger economy going forward than we did coming into COVID. But I'm not going to necessarily say we were headed for a recession imminently, right? But going forward, I do think that this does give us an opportunity to maybe reorganize our economy, A, to make it more efficient, but B, also, to work better for more people from an equality standpoint. I think that's certainly a theme that we talk about from an investment standpoint, and obviously we see on our daily lives. That's going to be a theme going forward. So hopefully that gives you. By the way, let me just also mention this. I don't expect jobs to get back to the level we were at anytime soon, right? In fact, we think it's going to take about 2.5 years to get jobs back to this previous level. And we think the actual economy, right, that's going to take until the end of next year to get back to its previous pre-COVID level. So you want $21 trillion GDP in the US, in our opinion, still probably going to take until the end of next year. All right. I'll give you this, though. After the financial crisis, it took 4.5 years for us to gain back all the jobs we lost during the financial crisis. Okay. 4.5 years. We think that we can potentially cut that in half, right? Maybe even further. So even if the job recovery is slow, doesn't mean that the economy can't continue to increase, doesn't mean the markets can't do well.
Great. Thank you, Nick. Appreciate that. So we'd like to thank Nick and Mike with Merrill, and appreciate your time. There were some real good insights there, a lot of good takeaways, and I took a lot of notes, and hopefully everyone on the call enjoyed that. I want to thank Mario at SU, Salisbury University, for helping us put this together behind the scenes, and also all of our sponsors. Without our sponsors, we would not be able to do this. M&T Bank, Delmarva Veteran Builders, Merrill, Bank of America Company, Hebron Savings Bank, Insurance Market, Bank of Delmarva, Farm Credit, Avery Hall, TRS, and W.R. McKean. Also our committee members, Amy, Rick, Wesley, Tony, Steve, Kelly, and Amber. Thank you all for putting this together. If you have not received our market report, we did put together a exclusive Delmarva Peninsula 2019 market report. For everybody that attends, please reach out to us and we can mail you one of those. in the upcoming days here. Also wanted to thank each and every one of you for attending. Our next commercial real estate virtual series will be Wednesday, July the 1st, 10 a.m. Will feature Kevin Magiacomo, who is the president and CEO of SVN International. He will be speaking about commercial real estate trends and any, in this changing market across the country, as well as locally and regionally. So again, we thank you for attending. As we move through this recovery, we wish you well on getting back to business. Thank you all.